Welcome to today's lesson, School of Law students. Our unit is Fundamentals of Accounting and Bookkeeping. Our topic of coverage is on final accounts with an inclination on the comprehensive statement of income, otherwise known as trading profit and loss account. Now, when are final accounts prepared? In practice, it's expected that at the end of every trading period or at the end of every financial year, a company should be in a position to report its financial performance, changes in financial performance at the end of the 12-month trading period. Of course, you'll appreciate the fact that in practice, you really don't have to wait for the 12-month period. There will be quarterly statements, meaning that after every 3 months, a business is able to prepare these particular statements. There's half yearly, meaning at the end of every 6 months. And then, of course, there will be now the end of that particular trading period. So it should never really surprise you when you hear of quarter 1, quarter 2, quarter 3, and then, of course, the last quarter. In that case, remember, investors and potential investors as well, their focus will be on how the company or the business is performing. So, the outline or the presentation of this particular final accounts will be in such a manner that all the various users, whether internal or external users, will be in a position to make informed and meaningful judgments. In this case, with the comprehensive statement of income, we consider it to be a 2-in-1 account, whereby the first part simply reports the trading activities, while in the second part, this is where we have the profit and loss account. But then again, in practice, we have it combined as one. So, how is it represented? Of course, we start off with name of the company, and then you make reference to the type of account that you're making or you're preparing. So in this case, we have the comprehensive statement of income, and then be sure to indicate the date, the month, and the year. So we have for the year ended, say, 31st December 2019. It has 3 columns. We have the account title, we have another for currency, and of course, second one still for currency. So the first part, and I would like you to be very keen on this, the first part from sales all the way to gross profit, we refer to this as the trading account. When we talk of sales, how do we arrive at sales? You simply consider a certain number of units at a certain selling price per unit to give us sales. When we talk of return inwards, these are simply goods taken back by customers to the business by virtue of the fact that they did not meet certain specifications. Say, for instance, they were spoiled goods, they were expired. If not that, they were probably in excess, inferior, substandard, okay? So the impact of return inwards is it will either minimize the sales, and of course, the customer, assuming that he or she had acquired this particular stock on credit terms, then that means they are debtors. So the amount of money that they owe the business will have decreased. So basically, it will be a decrease in form, or rather in terms of, or on the debtors or accounts receivables entry. So the difference between the two now gives us what you refer to as the net sales. And this is actually what represents the much that the business has generated. The second part, we have cost of sales. Now, with cost of sales, it's not just an individual account. It's not just an individual figure. It will be comprised of a series of other accounts to constitute the cost of sales. So in this case, if you take a look at our first item, opening stock. Opening stock will only be available for a business that has been operating. Since, say, the business operated, or rather was incorporated in the year 2019. At the end of the year, they'll have a closing stock. Now, the closing stock reported on 31st December 2019 is what will be brought forward to the year 2020 as opening stock. So, for a new business, for a business that started its operations in the year 2020, opening stock will not be available. Again, we have purchases. So this is purely the general merchandise that the business has acquired or that has bought with the intent of resale. So if you acquire something else, but the ultimate goal is not to sell, say motor vehicles, yet you deal with just general merchandise, then that purchase of a motor vehicle is simply not under purchases. It will not comprise of the cost of sales. Now, when you make these purchases, it's possible that you are likely to have a transport expense. Now, that transport expense that you pay from the supplier to the business, that's what we refer to as carriage inwards. On the other hand, we have return outwards. So for return outwards, they are simply goods, inventory, merchandise, or stock that the business takes back to the source, in this case, the supplier. So the same reasons that will make your customers to have return inwards are more or less the same reason as to why you as the business will return goods back to the source. So up to that point, when you now consider the opening stock, you add your purchases, you add the carriage inwards, and then of course you deduct the return outwards. It gives us what we refer to as the cost of stock or cost of goods available for sale. So in order now to get entirely the cost of sales, for every business, regardless of whether it's in its initial year of operation or it has been in operation for quite some time, closing stock has to be provided. So for the closing stock, it's what will be considered to be the remnant after either having bought, having sold, having returned, customers having returned, and then of course all that gives us the cost of sales. And so the final bit will be to deduct net sales. Remember we said our first part, net sales, minus our cost of sales, which is part 2, and we have the amount here to give us the gross profit. So of course you realize that the gross profit will always be reported by all companies. Issues begin when expenses start being incurred and so forth. Now, where do we get the return inwards amount? I would like us to flash back to what we refer, or to what we had previously discussed on source documents and books of original entry. One of the books of original entry, or what we would refer to as the prime books of entry, are the return inwards. So for all the returns, or for all the sales return, they will be recorded in that. So you should really not worry where we are going to get this particular amount. And then again, for all return outwards, then we'll have that amount being sourced or being obtained from the purchases return or return outwards journal. Hope you're together up to that point. So that being part of the trading account, we move on to the second part. Remember we said that it's a two-in-one statement. The second part has the profit and loss account. So the gross profit that we reported here, it is absorbed as part of income in the business. So in that case, we will recognize the gross profit, and then we have additional sources of income. Sources of income in this case are the cash inflows. So they are very easy to identify. We have something like discount received. You probably bought stock. Instead of paying full amount, by virtue of the fact that you did a bulk purchase, you enjoyed the economies of scale. So a certain discount was offered. And so assuming maybe instead of paying probably 10,000 shillings, you end up paying 9,000 shillings, depending on the terms that they have. Rent received. Rent in this case, probably you've put up some apartments, some office blocks and so forth. So that is purely an inflow for the business. Interest received, this one is very common, especially when you're dealing with bank deposits in form of fixed deposit account. So you probably had a 1-year agreement with the bank. You deposited some 5 million shillings. At the end of the financial period, they paid you at a rate of, say, 7%. Dividends received. You've probably acquired shares or stock from various public limited companies, say the companies that are on the Nairobi Securities Exchange. And so at the end of every trading period, there's that dividend that you receive. Of course, now it will all be dependent with whether you are an ordinary shareholder, or what we refer to as a common shareholder, or a preferential or preference shareholder. And then, of course, any other source of income that the business or the company may be having. Now, I would like us to focus on this. One thing you realize, someone may probably think, this is so direct. Yeah? We are just talking about received. Well, no problem. If you've been provided, or if information is provided in form of a trial balance, which we said is purely a list of all closing balances, remember the trial balance guidelines. You will need to apply your accounting knowledge to find out which of these accounts is either income or expense. So the guideline will be in such a manner that assets and expenses, they'll always be debited, while liabilities, owner's equity, and capital or income will be credited. So, without even having these descriptive terms, it becomes very easy to tell which account will be an income and which one will be an expense. Say, for instance, you have rent, a credit entry of 20,000. Of course, that will be, or you'll be in a position to interpret that as income. Say, on the other hand, you have dividends, a credit entry again of 30,000. So you'll be in a position to really tell whether it's income or expense. And then, of course, let's take a look at the expense part of it. So expenses in this case, remember we said expenses denote cash outflows. However, these cash outflows are in such a manner that it will not be money spent or money used to acquire merchandise. So anything to do with purchase with the intention of resale will not be part of the expenses. So carriage outwards, what are they? This is purely a transport expense that emanates from, I'll take you back to the trading account. It emanates from return outwards. When you reject goods by virtue of the fact that, say they don't just fit your specifications. The much that you incur in terms of transport from the business to the or back to the supplier, we refer to that particular expense as carriage outwards. So this one you don't, or it doesn't form part of cost of sales. Please never confuse that. When you offer your customers discounts, either to encourage them to purchase more, or you're simply rolling out a new item, and so your strategy of trying to penetrate into the market is on pricing, then by virtue of the fact that you'll be selling at a lower price than the difference, we refer to that as discounts allowed. And then of course that is simply a cost that the business should be in a position to absorb. Another expense we have the postages and stationaries. You can also talk of office supplies or office consumables. So another expense we have is salaries and wages. Of course, these are purely direct labor costs as well as indirect labor costs that will be paid on employees, or if you so desire, human capital for the various services that they render or for the various jobs that they perform in that particular business. Next, we have rent. Rent could either be, of course, rent paid. It could either be as a result of having occupied a certain premises. If not that, you've probably leased out a godown or a warehouse for storage facilities. If not that, there's the much that you pay to the relevant authorities, say to the county governments, in form of either rent or rates. Another expense, insurance. Insurance will go hand in hand with plant, property, and equipment. A prudent business will have to mitigate or cushion itself from occurrence of unforeseen eventualities. And so when you visit a certain insurance firm just to acquire a cover, then we'll consider that as expense. Bank charges is the other. In this case, bank charges may arise either from acquisition of checkbooks, processing fees, say when you acquire a commercial bank loan, when you have an ATM card and you need to renew it. Another expense we have is repairs and maintenance. So this will simply be as a result of revenue expenditure. Say for instance, having certain improvements done on the property, premises, buildings, and such. Which other expenses can you simply come up with? Again, they may not be straightforward. If we use the trial balance and you have rent, a debit entry of 1,000,000 shillings, insurance, a debit entry of 2,000,000 shillings, then your interpretation is both rent and insurance are simply expenses. That's why they've been posted as debit entries. Having done that, we go back to this. We'll add the gross profit to the total income, and then we deduct all our expenses. So if the total income is greater than the expenses, we expect that this particular company will report a net profit. However, if expenses are greater than income, or if income is less than expenses, then this company will report a net loss. So with this particular breakdown, again, you realize that it will also be very much applicable when it comes to decision making, by virtue of the fact that, if you recall, the generally accepted accounting principle of consistency. Remember, the way accounting is done, accountants will use a similar language to denote similar things. So, assuming this financial statement is for the year 2019, it's not the business's initial year of operation. So there was 2018 and there was, say, 2017. It will be possible to tell how the business has been performing between 2017, 2018, and 2019. Are things getting better? Are things getting worse? And then, of course, you may probably decide that, say you have an expense like transport or fuel. Across the years, it only seems to be increasing. Say you have repairs and maintenance or motor vehicle expenses. Again, across the years, it only seems to be increasing. But then on the other hand, you really can't tell what has been happening in terms of, say, revenue probably has not increased by a significant margin and so forth. So in that case, as a manager, as an accountant, or as the proprietor of the business, you can decide, probably, we can break down these particular expenses to see how did we arrive at them. So if it's repairs and maintenance or motor vehicle expenses, which are these vehicles? Maybe there's one that is or has been quite problematic, and you may just decide it's time we sold it off. So as we wrap up, it's only good enough that a business tries to minimize on the occurrence of expenses, and then, of course, try as much as possible to diversify so that they can get additional sources of income. You don't have to, say, rely on just this particular sales. So the next time, it should not like catch you by surprise when you hear that a company has been making or has been incurring losses for 5 years in a row. Of course, if you consider the public limited companies on the Nairobi Securities Exchange, we know of quite a number that have been in such a position, and things seem not to be getting any better. Okay, unless there's any query, that basically brings us to the end of our lesson. Thank you.
These televised lectures supplement our robust online learning going on our MKU online platform. You can view more on our televised lectures via our online platform. We are in a digital era, and Mount Kenya University knows this. The following are the steps to follow so as to complete your online application. Download the application form from the website www.mku.ac.ke. Attach copies of your academic certificates and ID. Pay the application fees via M-Pesa pay bill number 270988. Your ID is the account number. 2,000 shillings is the charge for a postgraduate. You can also deposit in the bank accounts provided on the website. Then email all the above to apply@mku.ac.ke.